Hey guys, hi everyone. My name is Xuehen, also known as Wolf of Hougang Street. In that's my nickname in Telegram. So, so today I'll be sharing with you a very simple framework on investing. But before I get to that, maybe let me just give you a very quick introduction about myself. I started investing about 3 years ago, investing on the side, mainly investing in equities and only equities. And my approach to investing is mainly value investing. Along the way, recently I started tilted towards growth investing. So when Terrence or T.U.B investing first reached out to me on sharing with you guys about sharing like 15 minutes about something, right? I thought why not come up with something, a very simple framework to help the newbies get started with their investing journey. So let's begin, right? Um, so so I want to share a simple framework. Keep in mind that this framework is meant to be as broad as possible. I intend to keep it very generic, right? Because the framework only works if it can be applied to any single company out there. So basically, my framework contains four areas: the business, the financials, the management, and the valuation. And in later on, I will actually explain a bit in details on each of these pieces. So the business, key question that I ask myself when I look at the business is really one simple question, right? What does the company do? And my first consideration here would be, who are the customers? So when you think about who are the customers, what you want to look at is really the profile of the customers. And this brings in the idea of different kinds of businesses out there. About to simplify a bit, we can actually split the all companies out there into two broad categories: B2Cs or B2Bs, also known as business to consumer and business to business. So I think the key thing here is really to understand the profile of the customers. For example, B2C businesses that I think of could be like companies like McDonald's, Apple, and for B2B, I can think of, let's say, Facebook, Google, Visa, Microsoft. And I think the key thing here is really to really explore the profile of customers. One thing to keep in mind is that typically B2C companies are typically easier to understand and analyze than B2B companies. Now, of course, we go deeper level, right? We can talk about different kinds like P2P and all that other stuff. And the next consideration I think about is what exactly are the customers paying for? And I think this brings in an interesting idea that if you talk about investing, you know, most people, when they read about Warren Buffett, they'll see this quote called value is what price is what you pay, value is what you get, right? So really, customers paying for something, they get value in exchange, right? So the key question really is understanding what is that value that they get. Does that thing they pay for actually solve a certain problem, or does it provide a specific benefit? And I think if one actually manage to figure out or answer these two questions, right, of who are the customers and what they're paying for, I think you can have pretty good clarity about what the business does. And the next consideration would be an added level of detail. So we look at the revenue breakdown. What is the components of the revenue? We look at revenue by segment, we look at revenue by geography. And I think one thing to highlight here is that if you look at the segment, right, typically I will pay attention to the segment that takes up. So for any company, I will typically pay attention to the segment that takes up the most of the revenue. And another thing to note is that when you look at companies like, let's say, for example, Amazon, right, you can see that if you split a segment, they can have very different profiles. So in the case of Amazon, you can see that they are split into e-commerce, which is a P2P business, and AWS, which is B2B. So the key thing when I look at financials is that it should give you pretty good insights into the past. So the one of the things that I look at in the income statement is I look for consistent revenue growth. consistent net profit growth, as well as high net profit margin. And I think probably at this point in time, right, most of you will be wondering, how do I know what is good enough? How do I know like what's the number to look at? Revenue growth, net profit growth, and what is exactly its high net profit margin? And I think this is where it can get pretty interesting and also subjective at the same time, because different people have different standards for what counts as good. So how I would like to put it is, just use a random number, let's say 10% or 15%, and see how it works for you. So if that number works for you, fine. If it doesn't, then you have to adjust accordingly. So what I look for in a cash flow statement is basically the operating cash flow and the free cash flow. One thing to note is that if you look at, just by looking at like these metrics that I mentioned, right, in the income statement and cash flow statement, it is possible to have pretty good starting point into understanding more about the business. So that's where I would say the financials can be linked back to the business, right? For example, if you note the word consistent, businesses with not so consistent revenue growth. So for example, if the revenue for a particular company goes up by 5%, and then next year it goes up by 50%, and then next year it drops by 10%. Actually, that kind of movement should give you a pretty good starting point in terms of understanding more about the business model. And one thing to highlight is, right, is that typically you expect the operating cash flow, which is OCF, your OCF to be higher than your net profit margin. And this is because your net profit margin usually has non-cash expenses like depreciation. And I think this is definitely very applicable to companies with very high capex, like your huge manufacturing companies. So this is something they know. And of course, if you extend on this, right, if you flip it around, right, it would probably be an anomaly if the company has a higher net profit margin, a constantly higher net profit than your operating cash flow. In the balance sheet, usually in the balance sheet it will contain what the company owns, right? So accounting 101 for everyone is that assets equals to equities as liabilities. What it really means is assets is what the company owns, and equities is what the shareholder owns, and liabilities is what the company owes. So this equation, I mean, it's good to know, right? So from this from the balance sheet, typically I will pay attention to the larger items, what exactly is taking up majority of the assets and what is taking up majority of the equities and liabilities as well. Typically, I'll say that less bank borrowings is better for the company, right? Generally, but not always all the time. And another thing I look at is the returns of equity. So I see it as a measure of how efficient a company is in generating profits out of its equity base. So the management to me is a very interesting piece, because it potentially can give you very good insights about the future of the company. And how I think about it usually is, I will usually step in the shoes of the management and I look at the company based on my understanding of the company, and I think about it in terms of it's a choice, right? There's always a choice between reinvesting your profits into the business and giving out dividends to reward everyone. And I think when we talk about reinvesting versus dividends, we can actually look at two considerations, which is your investors' risk profile. So typically younger people have a higher risk profile, and they'll probably go for higher growth companies. And typically, and also conversely, people who are maybe in their 50s or in the leisure stage of their life, they will typically prefer higher dividends. And another consideration is at the company level, where you see that companies at infancy phase, for example, or just starting out, right, typically very high growth and don't give out dividends. And the converse is also true. But I think what's interesting here is the reinvesting piece, right? So this is where I think this is where I'll probably spend a considerable amount of time, especially for growth companies. And it really points to the bigger question of, how do I grow my business? I've just done three different ways of growing a business. It could be organic growth, acquisitions, diversifying. But I think at the end of the day, what we want to look at is really having a very, I'll say, a fairly good understanding of the business, and that's where you would probably be in a position to give a qualitative assessment about what's the best way for the company to move forward. So for the valuation piece, I see it as a way to decide whether the company at the current share price is cheap, fairly valued, or expensive. So the key ratio that I'm looking at is price to earnings. How I look at price to earnings is really a ratio between share price and earnings per share. And if you think about it, right, share price is actually a subjective measure. It is decided by the market. It is decided by humans. And earnings per share is an objective measure because it is determined by the performance of the company by net profit. So it is simply a ratio, right? Typically, I mean, when you see the share price keep going up, you can use P as a measure to decide to actually have a sense of how optimistic the market is or how pessimistic the market is. And actually, to add on to that, right, your price to earnings ratio, if you multiply the share price and earnings per share by the outstanding shares, you actually get a different view of the same metric, which is market cap versus earnings. And one way to think about this as well is that usually for higher growth companies or specifically higher earnings growth company, you will have higher PE. And as an extension to this, right, if you can actually pick a few companies with similar earnings growth, theoretically, by right, they should have the same PE. So this is like a clue, right? You can actually use this to have a sense of like, oh, this is a mispricing because this company is perpetually with the same growth rate, lower PE than the other company. So I've talked about four different areas to look at when it comes to a company, right? So I have a couple more points that I think would definitely help you guys in starting on an investment journey. So the first thing that I will really encourage, right, and suggest is that I believe it's very important to analyze the company end to end. Sounds very how do I put it, strange, right? Because most people don't do that. And analyzing a company end to end basically means typically you actually don't refer to analyst reports, you don't refer to bloggers analysis, you actually minimize extra analysis. And the idea is to really do the groundwork yourself. How I would like to, I would say one way to do it is actually to find a company that interests you. So for example, if you're interested in the field of, you're interested in gaming in general, so typically you can actually try to read out about a company or start analyzing a company in the gaming space. Or let's say you're personally interested in shopping, right? You can maybe go for like e-commerce companies. So it'll be easier if you start a company that interests you. And the next point I want to highlight is that what I observe around me is that a lot of people, very common, they tend to ask, maybe they tend to ask too much, ask too many questions, and the danger here is that if you don't develop your own views but you keep looking outside yourself for answers, that's where you might feel very overwhelmed about so many different information because you don't even spend like enough time or energy about consolidating or refining how you view a company or how you view investments. So what I will highly encourage is that try to have opinions about things, right? A very easy starting point is why do you like this company? Why is it good? Why is it bad? Right? Justify your reasons. And actually the point here is that it doesn't matter whether you're right or wrong, as long as you keep an open mind and you keep refining your views. And this brings me to the next point of the idea that investing is really more than just financial ratios. I believe there's a lot more qualitative analysis and a lot of like subjective views at play. And this is where I think it gets very interesting. Next point I want to highlight is so typically I understand a lot of people when they look at the financial statement, they look at the balance sheet or annual report, they see, wow, very cheap, a lot of terms I don't understand. And I will give, so how I think about it is I'll just highlight 3 questions, right, that I think will help you a lot. And really, these three criteria should be sufficient to analyze, to actually go through like an annual report with so many jargons. You just need to ask yourself, what does this mean? You don't understand. What does this mean? What are the implications of this? And is this good or bad? So for example, I can just bring in like random terms, right? Like for example, what is share buybacks? What does it do, right? So if you understand what share buyback is about, you probably can have a sense of what are the implications, in what case is it good, in what case is bad, and really is it good or bad. And maybe you can talk about, let's say, shares compensation, or you talk about debt, right? Is debt necessarily good or bad, right? Necessarily bad. So these three questions will help you a lot. And the next thing I want to bring out is really attempt to simplify as much as possible. Just keep simplifying whatever you know. One starting point that one starting point that I would say quite handy, right, is try to ignore competitors. Sounds very unconventional, but the idea is that you really look into a company deep enough, or I mean, look at a company and don't be swayed by the fact that competitors exist, because at the end of the day, you're an investor, right? And you if the company is good enough, actually you probably don't have to pay enough. You don't really need to care about your competitors. And another thing to note is that, sometimes when you look at the annual reports and all that stuff, you have to always remind yourself that you are an investor. So you are just trying to get insights about the company. Your job is not to like detect fraud or detect fraud and come out with conspiracy theories. And the last point I want to bring up is I think in general a lot of people pay too much attention to price, right? They always talk about price, and then the next step will be, valuation. How do I value high growth companies? How do I value that? How do I value this? And what I want to encourage is really there are much more important questions to ask than valuation. I think if you pay more attention to the business, the management, and financials, you actually learn more in the process, and you get better at really having a view and really deciding, this company is good enough for me. So with that, I end my presentation. Thanks, guys.